Hi, I'm Dan Passarelli of Market Taker Mentoring here on the floor of the CME Group, the largest U.S. futures exchange. Now, on this exchange, there are both options and futures traded. I'm often asked what the difference is. Now, some people commit themselves to only trading futures, and some people commit themselves to only trading options. However, each have their advantages. Let's first talk about futures. A futures contract is effectively a contract between two parties to buy or sell an underlying asset. For example, I could buy a corn futures contract, and therefore, as long as I hold that futures contract, I'm obligated on the expiration date to actually buy corn from the person who is short that futures contract. Now, the reason why these contracts exist is because at the price at which I would buy that futures contract, I effectively lock in a price. If the future goes up or down from that point, I'll make or lose money, just as if I'm taking possession of the underlying asset right then and there. Except the actual transfer of possession doesn't happen until the expiration date of the future. Now, there's many applications for that. One, of course, is hedging. Another is speculation. As far as traders go with speculation, futures can be an excellent speculative vehicle because I can control a great deal of an asset with a very small amount of money. When I buy or sell a futures contract, I'm able to only post a small amount of money that we call margin, the initial margin requirement, and I can control much more than I could if I was actually buying or selling the physical commodity. Now let's talk about options. They have advantages and disadvantages over futures. An option is the right to buy the futures contract or sell the futures contract, depending if it's a call or a put, at some point in the future. Now, this has a whole number of implications. First of all, if I buy an options contract, I'm buying the right to buy the future. So I'm paying for that right. Now, why would I do that? Well, let's say that there's a futures contract that's at 100. And I buy the 105 strike calls. That gives me the right to buy that future if it goes above and beyond 105. Maybe I would pay, say, $1 for that contract. If the future doesn't go above 105, in fact, if it goes down to 90, 80, 70 to 50, all I lose is that $1 that I paid. I lose much less by owning the call. However, if the futures contract goes up, if it goes above 105, I might want to exercise that call, that right to buy the future at 105. If the future goes to 110, 120, 130, and I own the right to buy it at 105, I can have an extremely high leveraged profit. So the trade-off is that I have protection to the downside and I have unlimited profits to the upside. However, I pay for that right. My name is Dan Passarelli. I'm here on the floor of the CME Group, and we would love for you to try our daily futures class where you get 4 to 5 futures trade ideas every single day in a webinar style format. Simply visit markettaker.com/FC99. That's market like futures market, taker like I take something, /FC99. And you can try our class for a full month for just $99. I'm Dan Passarelli here on the floor of the CME Group. Trade well.